My name is Eric Boyce, the CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for August 3rd, 2020. Please see our disclaimer for important information. So in our Market Minutes this week, we've got several things going on. Obviously, it's hot outside, it's summer, there's a lot of pent-up energy. I think people are interested in getting out and traveling. A lot of uncertainties with regard to how school is going to roll out in the fall, uncertainties with regard to how fall sports are going to roll out, and I think some general trepidation, I think, beginning to kind of filter into the market. You're seeing some consumer sentiment numbers begin to flag a little bit, and some of the high frequency data that we've been watching for several months now the data is not bad. It's just not moving at the same momentum that we saw in May and into June. And so, by and large, we're just seeing data kind of pause a little bit. And I think that's very symptomatic of what we're seeing in COVID data and some of the tweaks that we've seen in certain states with regard to open economies. Some states have kind of pulled back capacity numbers for restaurants and things like that, and so just various things that we've seen, a little bit of mixed blessings in. So on the one hand, let's talk about the markets. So U.S. equities last week rose for the fourth time in 5 weeks, and actually the S&P is now positive for the year. So for the month of July, the S&P 500 was up 5.5%. Year to date, it's up 1.25%. The Dow Jones was up about 2.4% for the month, but still remains down about 7.4% for the year. And then NASDAQ, obviously, which is tech heavy, and we know that tech has been, by and large, the leader of this market. The NASDAQ was up about 6.8% for the month and is up almost 20% for the year. The Russell, on the other hand, when we're dealing with a lot of small caps, is down 11.3% for the year, but actually had a positive month. So it's we saw a little bit of churn, I guess, a little bit, even during some of the earnings announcements by some of the large tech companies. It led to days where the large cap indices actually underperformed the small cap indices. So the Russell 2000 was up 2.7%. So again, we still have fairly strong leadership in the market and some relatively narrow leadership in the market, but we're beginning to see a little bit more participation across the board, even as we see some of this economic and short-term high-frequency data kind of flag a little bit. Overseas markets, as defined by the MSCI EFA index, they were up about 2.2% for the month, although they're still down about 10.6%. And we saw volatility drop considerably during the month. We're probably down around the 24 or 25 level, which was down about 20% over the last month, even though volatility is up considerably year to date. But in the bond market, Treasury rates continue to slide. We have certainly had fresh concerns about economic growth, and then we still have this very dovish overtone being put forth by the Federal Reserve and Federal Open Market Committee. And so we've seen some money flows into treasuries and into bonds. The 10-year Treasury was actually below 0.6% in yield for most of the week, and at one point it was down at 0.52%, which is the lowest that we've seen since we had a really dramatic and visceral rush to quality there during the March equity sell-off. And then we still see high yield spreads continue to come in quite a bit. We still see bonds this year outperforming equities. Barclays aggregate was only up 1.5%, but it's still up about 7%, 7.5% for the year. And then again, we still see loans underperform. High yield bonds are actually now positive for the year, so that's a good development. The dollar for its part, was down about 4% for the month and is down about 3% for the year. And dollar weakness coupled with negative real treasury yields, that is a nominal yield less inflation, and those are negative right now. So a negative real yield coupled with a weaker dollar has really given life to gold. And so we have certainly seen some strong performance out of gold, which was up 9% for the month and is up about 27% for the year. Crude oil had a good month as well, 2.5% up for the month, although still down about 34% for the year. So if you had an equal weighted basket of all commodities, you probably would be kind of flatlining overall. But if you had a strong tilt towards gold, you would be doing quite better. The economy, obviously the number that was reported was negative 32.9% for the quarter, and that's an annualized number. So annualized, the economy was down almost 33% during the second quarter. We had a fairly large drop in consumption, which we were expecting. Business investment also fell about 27%. Consumption itself was down about 35%. We had, basically, this weak report coupled with some of the trepidation that we see in the data, at least over the near term, is kind of given a little bit of pause. We've had a good month in the market, but we're seeing kind of symptoms that, especially with the rotation into treasuries, that there's a little bit of hedging of bets going on in terms of mainstream in investor sentiment. So continuing claims was back above 17 million, which was a second consecutive weekly increase that we've seen from the labor market, and also the employment picture for overall, we've seen a little bit of stalling in the progress that we saw in the labor market. And then in addition to that, we saw the consumer confidence number drop a little bit. But talking about equity still, and I think we'll just kind of basically focus probably much of our energy today on this, that companies are really outperforming their estimates. And we know that coming into this reporting season, that a lot of people have ratcheted their estimates down. Frankly, people didn't have any idea where estimates were going to come in, and so the bar was set fairly low. But more than 300 S&P 500 companies have reported second quarter earnings to date, and 85% have beat those estimates by an average of over 22%. Whereas in the first quarter, 70% of the companies beat their estimates, but only by an average of 2%. And during the same quarter last year, second quarter of 2019, 75% beat estimates by an average of 5%. So we had resounding strong performance for the companies that have reported thus far. But nevertheless, we still see a strong dislocation in leadership in the sectors that are outperforming versus the ones that are not. And urge you, we've got a few slides in our charts of the week that can expand on that a little bit more. But we've got certain indices like the NASDAQ, which is trading at a 40% premium to its 5-year average, and so we've had a tremendous move in certain areas and less than stellar move in others. As we sit here at the beginning of August, we know that we don't have another stimulus package approved. Now the GOP has proposed 1.1 trillion. And the Democrats have proposed something that's well over 3 trillion. And I think there's going to be a meeting of the minds somewhere in the middle. That I think is a fairly strong conventional wisdom shared by many people. But within that, we know that we have the extra $600 going to unemployment benefits, which expired on Friday. And we know that the Fed and Congress both pumped almost $5 trillion into the economy in the second quarter. And interestingly enough, as pointed out by Sandy Leeds, that compares against a nominal economic backdrop of 4.85 trillion. So just think about that. We had more stimulus pumped into the economy than we had, in the value of the economy. Never before have we had fiscal and monetary stimulus which matched our quarterly GDP number. But interestingly enough, again, this is drawing on his comments, which is out of a Barron's article over the weekend, that economic growth, or the size of the economy itself, dropped $500 billion in current dollar terms, yet the market cap of U.S. stocks increased over $7 trillion. And very importantly enough, for the things that we watch, the market cap hit 2 times normal nominal GDP, and the previous record during the tech bubble was 1.87. So that just shows you the impact on large technology companies, on the market, and that market cap now in uncharted territory relative to GDP. And again, we've been monitoring the pace of personal income, which soared about 1.4 trillion in the second quarter, but that's primarily because we had over $2 trillion in transfer payments from the government. Had we not had that, I think we would have been looking at a far, far worse GDP picture. But interestingly enough, if you look at the savings rate, which we knew increased by quite a bit, the people that were saving the money were the higher income earners, and the people that were spending the money that went into this consumer spending number were actually the lower wage earners that were probably the most benefited of the cohorts within our population for stimulus. And so I mentioned high frequency data, and what it really kind of shows us is that we've got some risk in the market we need to watch. Obviously, there's progress that's continuing to be made on vaccines, and we'll need to continue to have those positive items hit the public mainstream to continue to give us this feeling that we are going to have, give us this expectation rather that 2021 is going to bear evidence of this uptick, that we're going to have this U-shaped recovery, and that we're not going to necessarily fall back into this W. But there is concern about that, and I think people are watching the high frequency data. Again, that includes things like TSA checkpoint data, open table reservations in restaurants, like weekly rail car loadings and freight numbers, as well as movie tickets, and also gasoline purchases. So we've seen data, on small businesses that are responsible for half of U.S. employment, that the improvements have started to fade, and we're still down considerably from the beginning of the year, and that the number of small businesses that are open is dropping a little bit, again, speaking to the stress that small companies are facing during this time. And even companies that have received a lot of PPP assistance are laying off a fair amount of employees. And and then we look at consumer sentiment. We've got some charts in our weekly chart pack on this, but the sentiment numbers are beginning to erode a little bit. And so daily consumer spending data actually shows a decline from early July. And you can see this in a lot of the high frequency numbers, but it's interesting, and I'll point this out again, is that the weakness is really more pronounced in the high wage earner category, because those people are saving, and the savings number has really taken off, and they're actually consuming less. So and those are the people that have the most capacity to spend. And so we, while I think we would all in our personal lives enjoy having a little bit more savings, still in terms of economic benefit, we certainly want people that have the capacity to spend to actually be out in the economy spending. So I think what this really goes to is that August is going to be kind of an inflection month. We've got the election coming up in literally 3 months from today, and there's going to be a lot of rhetoric that's going to be bandied about And I think it's apt to create some turbulence and maybe a little uptick in our volatility as we head towards the election. That's very, very typical, actually, in an election cycle. So, again, just inflation, which we haven't spent too much time on lately. If anything, we're probably in a disinflationary environment, although some goods like food have seen higher prices. But generally speaking, right now, the disinflation is kind of more broadly taken root because of weaker demand. And so I think we'll probably be in this environment of low to no inflation for a while, at least until we have uh, the sentiment numbers from the consumer pick up, a higher propensity to spend, which will probably itself be predicated on better data coming out of the virus, the pandemic beginning to wane, and then having a vaccine that allows us all to get back a little bit closer to where we were before February. But um, the other thing that we're going to have to monitor too is notwithstanding the next round of stimulus and how that's going to impact those that are unemployed, but how are we going to build back these jobs, and how long is it going to take for us to reconstruct that which has been destroyed from the pandemic? And we know that 22 million jobs, more or less, have been lost. And then a third of those have been kind of mostly regained, and a lot of those are in the lower paying cohort. But we still have an unemployment rate of over 11%, which is higher than it was during the financial crisis. And those that are that are less able to weather the storm, so to speak, have frankly been the most affected. And that actually extends beyond just the data, but it gets into ethnicity and some of those other things that can cause some social dislocations and irritations that will need to be addressed systemically going forward. But we still see the Fed continuing to do what it's going to do. We still see their basically the Fed being an extension of the U.S. Treasury, working hand in hand to make sure that rates remain low. I think there's a strong sense that with interest rates roughly about zero, that there's really no distinction from printing money or between printing money and increasing the national debt, because there's really no cost difference there. And that's kind of the basis of what people are calling the modern monetary theory. And I would expect to continue to see that take root well into next year and probably into 2022 as well, as the Fed has reiterated time and time again that they want to continue to make they want to continue to keep interest rates low. But that is pretty much the lion's share of what I wanted to say this week. We still have tensions with China, and I think we have more political rhetoric coming, and I think we'll have to pay close attention to the high frequency data during August and see how we get back to school, see how some of our businesses can maybe begin to gain a little bit more visibility. And obviously, we'll be tracking very, very closely our infection rates and hospitalization rates with regard to COVID. And fortunately, those numbers, at least amongst some of the Sun Belt high incidence states, those numbers are beginning to look a little bit better. So we can certainly keep hope alive. That will be it for my comments this week. And certainly hope that you have enjoyed these, and we look forward to continuing these conversations week after week. As well, so please see our information on your screen and drop us a line. We'd love to hear from you. We hope you stay safe and have a wonderful week.